If you're looking for a video that is going to tell you that market is going to crash, this video is not for you, because I have findings that actually might dispel that. On the other hand, if you're also looking for a video that's telling you to buy big right now because Fed is cutting rates, we're in a new bull cycle, I have also findings that suggest the opposite. So keep an open mind, because today I'll be sharing with you some important insights when I look through all the data that can possibly help you position your portfolio better for 2024. Hi guys, welcome back. As we look at S&P 500 today, the question really is, would markets go up like the one in green or go down like the arrow in red? The correct answer is no one knows for sure. And probably the better answer is don't be too confident in knowing which one it exactly is. Because if we were to pull up analysts' price targets polled in 2022 December, you realize that almost everybody got it wrong. You'd see that the range starts from 4,750, which is the one that's probably correct, and range all the way down to 3,400. In fact, if you look carefully, most of them hover between 3,009 to 4,200, not an extreme figure. In that case, if you're wondering what was S&P 500 back in December 2022, it was around the 4,000 mark. So most analysts gave a safe opinion, maybe to keep their rice bowl. So this point is to prove again that price targets are of little value. Now I guess everybody has seen the latest news that Fed is holding rates steady and has indicated 3 cuts coming in 2024. That will bring the targeted Fed rates to 4.5 to 4.75%. There are some who believe that this will signal a new bull market, correct? Because the reason why markets came down in 2021, 2022 was because Fed started to raise rates aggressively. So if interest rates going up is a bear market, interest rates coming down could become a bull market. There's some logic in the thinking, but let me show you some findings. There's one instance actually in 1995 where it was true. Back in 1995, Nasdaq rallied crazily for the next 4 years, gaining 400%. S&P 500, it more than doubled by 1999. This period is also known as the dot-com bubble. Could this happen again in 2024? I've done some homework for you, and you know I have the goods, so I invite you to smash the like button early and press on the subscribe, especially if you like updates on the markets that can help you in your investment journey. Now we all know that dot-com bubble was all because internet revolution, correct? E-commerce is just going to be so much better, etc, etc. We are going to see a brave new world. But as history has shown, that was 15-20 years premature, because only now in today's world is internet and e-commerce the dominant force. But hey, right now in today's world, we have this hot topic, correct? And it is none other than AI, artificial intelligence. Could we see a massive stock market rally because of AI revolution? Jump on the bubble right now because it's still early enough. Some may be thinking of that, but let me show you some contrary findings. Back in 1995, it's a bit unlike today. Fed rates actually came down from 10% all the way down to 3% in the preceding few years and stayed low. Take note again, it's from 10% to 3%. Such a massive reduction in terms of overall interest costs. It is undoubtedly going to fuel a lot of asset bubbles, which we can see now from hindsight that it became the dot-com bubble. However, in today's world, if we were to see the Fed rates, this chart will show that Fed has been very accommodative at least for the last 15 years, correct? They've dropped interest rates all the way down to almost 0% back in 2008, gradually raising it a bit in 2016, 17 and 18, but because of COVID, reduced it back down. This is an entirely different landscape from coming down from 10% to 3%, which will fuel asset bubbles. But there's something else I realized when I zoomed out and studied a bit deeper in terms of interest rates, recession, and S&P 500 performance. Take a look at this chart over here. You would see that there are many red dots signaling the end of a Fed rate hike cycle. End of Fed rate hike cycle in simplistic terms means Fed is not raising rates anymore and general interest costs will start to come down. What I've came to realize is that this is more often than not a start of a new bull cycle. The only exception is the one we've just discussed, which is 1995, signified in the purple dot. The blue dot is where we are at today. In addition, the end of rate hike cycle in 1995 was also a rare occasion where there was no recession in the next 1 to 2 years. If you look closely, after all the red dots, you would see a grey zone, correct? The grey zone is a recession period. And you would realize the grey zone is 1 to 2 years after each red dot. That could be also why many are worried about recession in possibly 2025. Because more often than not, interest rate hikes cause businesses to contract and inevitably cause a recession in some form. So let's try to describe some usual patterns. After every rate hike is completed, the market tends to rally a bit more on the good news, correct? And corporate earnings are still growing. This can go on for another 1 to 2 years, and then the market starts to peak out. If there's indeed a recession, the market correction will become a full-fledged crash. This is what we have realized in the last 2 market crises. So let's put some timeline to them. The most recent one, global financial crisis 2007 to 2009. The rate hike cycle actually completed in 2006. Market rallied or stayed strong all the way to 2007 and subsequently crashed in 2008. There was indeed a recession in 2008 and market eventually bottomed in 2009, starting a multi-year rally. Then what about for .com crash? Rate hike cycle completed in June 2020. Market didn't really rally up, but instead stayed flat for the next few months ahead. Subsequently in 2001, market started to come down and eventually crashed all the way to 2003. A recession was indeed confirmed in 2001 and ended in that year. For this .com crash, market actually did not bottom before the recession ended and only started its recovery in 4th quarter 2000. Now if you've learned something today, again smash the like button so we can reach a bigger audience together. And depending on when you're viewing this, there could be some opportunities to get started on your investing journey. With that, I'd like to introduce you to today's sponsor, who is Moomoo. Moomoo is a one-stop investment platform that's used by 1 in every 4 Singaporeans. And if you feel that market is uncertain, let me suggest Moomoo SG's generous sign-up promotion, which includes a 5.8% guaranteed return for Moomoo Cash Plus. This is for your first 80,000 and for the first 30 days. What's more is that there has been a new inclusion to Moomoo Cash Plus. In an exclusive collaboration with Fullerton Fund Management, Moomoo SG is pleased to introduce Fullerton SGD Liquidity Fund, which is Singapore's first retail SGD fund with enhanced intraday liquidity. That means you can have the flexibility of withdrawing your funds at any point of the trading day. Currently, there are 3 types of money market funds for you to choose from, and this 5.8% guaranteed by Moomoo SG means that they will be topping up the difference in cash coupon. Not just that, if you sign up today with Moomoo SG, you'll also be able to unlock 4 fractional share bundles containing popular US stocks like Nvidia, Tesla, Apple, C and NIO. And to add on icing to the cake, using my referral codes below, you can get an extra $20 cash coupon after depositing $100 and performing 1 buy trade. The total welcome bundle is $680. Check out the terms and conditions. And again, if you're new to Moomoo SG, I'd like to encourage you to sign up with links below. I'll next address whether this could be a new bull market or not. Because as you can see, S&P 500 has been climbing aggressively in the last few months, correct? So let's look back again at our 2 major bull markets, starting from 2009 and 2002. You know, history doesn't repeat itself, but it rhymes. So let's examine the factors behind them. The first factor to take note is that a bear market precedes a bull market. A bear market so severe that the index will drop more than 40% and not recover for a few years. This time round in 2022, it seems that most of big tech has recovered in less than 2 years. This chart over here is Meta Platform's share price. Although it did crash by 75%, do note again, it recovered very sharply after that and is back to its all-time highs. Meta is one of the Magnificent 7 who have locked in more than 50% gains for each and every one of them. It could be that AI hype has really short-circuited this bear market of 2022, because if you see, the total drop was only 23% and within a year. This is very different from global financial crisis 2008 and .com crash of 2000. The Magnificent 7 is pulling up the index by 71%. And as you can see in this bottom right chart, S&P 500 has rallied accordingly, even though S&P 493 is still going sideways. As a result, Magnificent 7 is now commanding 30% of S&P 500 already and can directly impact its performance. The second factor of a bull market is that there's usually a deep recession for a few quarters. We did not observe this in 2022, and recessions are just a normal economic cycle. It is usually when consumers like you and I start to build up more savings because we are concerned about job security and stuff. And for companies, they start to pull back on expansion plans and start to save. What happens after recession is that consumers start to spend more and companies start to expand more. So there's a contraction and expansion natural cycle. This time round, with no deep recession, there isn't that much cut in terms of corporate spending and consumer spending. So in conclusion, I have these few points to share with you. The first is that there seems to be no recession on the horizon for 2024. If there is, as history suggests, that would be in 2025. So don't be too pessimistic right now. The second conclusion is that Fed no longer raising interest rates, also known as peak Fed cycle, is usually close to the end of a bull market than the start of a new one. I've also mentioned two other points of typical new bull markets, which includes a very severe bear market preceding it and a very severe recession preceding it. So with that mentioned, don't be too optimistic of a new bull market that will 2x the index in the coming few years ahead. As Mr. John Templeton has mentioned, bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. Keep that in mind and invest safely. Let me introduce you to this previous video I've done on dollar cost averaging. I think it's a very simple and prudent approach to building up your portfolio. With that, I'll sign off from here and see you there. Take care as always. Goodbye.